A $10,000 investment in Starbucks on September 30th, 1998 would be worth almost $250,000 today. That same investment made in the stock market, measured by the S&P, would be worth $29,000. Starbucks represents a classic example of my contention that it is a market of stocks and not a stock market. Hello, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. With this video, I'm going to show you not just how that rate of return was generated by investing in Starbucks, but I'm also going to illustrate why, and I'm going to be showing you how valuation played an important role. The first thing I want to show you is that the rate of return that Starbucks generated for shareholders is directly related to the amount of earnings growth that the company generated over this time frame. This orange line represents a PE ratio of 20.6, which is equal to Starbucks' growth rate. And I want you to notice that this company's earnings have grown every year, year after year after year, averaging almost 21% a year. Even during the Great Recession, although the company did not grow earnings over that time frame, the company was still very profitable, producing its second and really third most profitable years in its history. And then, of course, once we came out of the recession, their growth dramatically increased again. It's important that investors understand that in the long run, earnings do drive market price, even though in the short run, prices can get disconnected from earnings. So let's put monthly closing stock prices on the graph here, and I want you to see that Starbucks stock price did eventually go where its earnings went. There were periods where the price got significantly above earnings, which is the fair valuation reference line here. And of course, during those periods when this happened, you saw a subsequent period where stock price reverted back to the mean or came back to earnings. And coming out of the recession, we saw a nice tracking of earnings. And then Starbucks again became very highly valued over this time frame. And more recently, this fiscal year, and actually, if you really look at it, going back to November of 2015, Starbucks stock price has been going sideways to drifting lower, primarily as a function of overvaluation. In other words, the price was so far above this orange line. Now, next, I'm going to add another calculation here called the normal PE ratio to illustrate that the market does have a penchant of valuing this stock at a very high valuation. Their normal price earnings ratio over this time frame has been almost 35, 34.7. You could argue that this company is worthy of that kind of high valuation, or you could recognize and understand that periods of high valuation are usually followed by periods of retrenching stock prices leading to fair valuation or undervaluation. Starbucks has become possibly fairly valued for the first time in 2 decades after the recent correction. Now, clearly, Starbucks is a growth stock, but let's look at some other aspects of the company. Let's look at their dividends and their dividend payout ratio. This company is now offering almost a 3% yield, which is really unheard of for a company growing this fast. And you can see they started their first dividend in September of 2010, but that dividend has increased nicely over the years. If we go back down to the performance report we looked at in the beginning, you can see that the company has increased its dividend by almost 25% a year. It's averaged actually 29.4% and a compound average growth rate of 28.7%, but that is partially skewed by a very high increase in dividends they had from 2010 to 2011. Otherwise, it's been increasing the dividends about 24 or 25% a year. And even though this is a growth stock that turned $10,000 into $220,000 on a capital appreciation basis, it also generated another $22,000 over this time frame. And you can see the actual dividend income was significantly, almost more than 4 times or approximately 4 times what you'd have received by investing in the average company or an index fund. But that's functionally related to the fact that Starbucks stock price was so cheap. The split adjusted price in September of '98 was $2.26. So your $10,000 investment would have bought 4,421.5 shares. And so therefore, when the company did start paying a dividend in 2010, even though it was only 18 cents a share, it represented almost $800. And because they increased that dividend so dramatically to over $1 a share last year, that $700 or $800 in dividends went up to $4,600 in very short time frame. It's real important that you understand that what I've shown you so far is a long-term perspective on the company. But as you change time frames, let's actually chop some years off of this graph and let's get down to just before they started paying the dividend. And I want you to notice that their earnings growth since the end of 2009, the beginning of fiscal year 2010, has still averaged over 20% a year. And that orange line now on this time frame represents a PE of 20. The blue line represents a PE of 28, not quite as high as we saw in the longer term graph, but we still see a situation where the market likes to put a high valuation on Starbucks. But once again, when the valuation got extended, where the PE was almost 40, 38.9 on October of 2015, performance over this couple of year time frame has actually been negative. In other words, a $10,000 investment would have shrunk to $7,975. You would have gotten a little bit of dividend income over that time frame, but you still lost just over 15% of your money, totally annualized loss of 6.2% per annum. However, what's important to note there is that not a whole lot bad was really happening to Starbucks. Their earnings growth was 19% in 2015, followed by 21% in 2016. Then 2017, they had a bad year. Their growth was only 8%. And of course, that's where a lot of the correction really occurred. But then they followed that up with 17%, or their forecast to grow 17% in fiscal year 2018, which ends in September, followed by 11 and 15%. That's the consensus of analysts following the company. So let's go down and look at forecasting for a moment and point something out. The growth rate has been over 20%. It's now expected to be about 14.7% over the next 3 to 5 years. There are 7 analysts making that forecast. If we look in a little closer, there are 28 analysts forecasting at the 17%, 16.99 to be precise, that I talked about earlier, followed by 33 analysts that look for about 10 3/4 to 11% growth next year, followed by 12 analysts that expect 15. Then it drops down to 3. And this is important because the further out you get, the more difficult it is to forecast. But having said that, you also need to take a look at the analyst scorecard on earnings here, and you'll realize that the company has actually met or beat estimations 100% of the time when a forecast was made 1 year in advance or when the forecast was made 2 years in advance. So the company's been given good guidance, and analysts have been able to forecast earnings quite well with this particular company. Importantly, one thing I want to stress in this video is the relationship between earnings growth and capital appreciation. Notice that Starbucks was trading pretty close to its orange line here, PEs in the low 20s during this time frame, and it's currently trading at about approximately that PE there. So this 20.4% growth rate over this time frame translated into a 19.7% capital appreciation, or approximately identical to the company's growth rate, just slightly less due to valuation considerations. But then we also have to add in the dividend income. Now, the capital gain comes from the stock going from point A to point B, but you also receive this dividend income in addition. That's why when we calculate the performance, you'll see that we get capital appreciation. 10,000 would have almost gone up 5-fold since September of 2009. Add in another $4,800 in dividends, and it did actually increase 5-fold, averaging over 21% a year, which now is slightly more than their growth rate, which again is a function of the total return coming from dividend income as well as capital appreciation. But I want you to note that it's the growth of earnings coupled with reasonable valuations that generated those rate of returns. On the flip side, had you bought the stock at a reasonable PE on September of 2009 of around 22 relative to this growth, and held it till it peaked in October of 2015, you actually would have made more money. Your $10,000 investment would have increased to over $68,000, giving you almost a 37.9% rate of return. That's total return plus dividends. So valuation is critical had you had the foresight to sell it. But again, as I showed you, the period since then has been weak because the company is reverting back to the mean or moving back into fair valuation. Nevertheless, let's take a look at some other metrics here that I think are important. Let's take a look at operating cash flow. And I like to look at operating cash flow when a company pays a dividend because this is a very unusual dividend yield for this company. Let's go ahead and put the dividend yield on the graph here, and you can see that normally Starbucks would be offering about 1.5%, 1.2%, 1%, 1.5% dividend yields. The dividend yield is extremely high relative to its historical norms, even though its history is also pretty short. But here's what I really want you to see. Their operating cash flow is covering their dividend. They didn't cover it in 2014, but otherwise they have strong operating cash flows more than adequately covering their dividends. From a standpoint of free cash flow, which is money left over after running the business, you have a very similar situation, operating cash flow. The company did cover their dividend in most years, except again for 2014, when the dividend payout ratio actually, was excessively high. They were paying out more than 100% of their earnings, which they really had a loss during that period of time. Of their free cash flow. So they had negative free cash flow in 2014, but otherwise they've generated very ample free cash. Finally, and as I often point out to readers and subscribers, that in the long run, there are many ways to value a stock other than earnings and cash flows. This is EBITDA, or earnings before interest, taxes, depreciation, and amortization. And what you're trying to do with this kind of a tool is you're trying to find an edge. When does it make sense to invest in the stock? Now you can see that in 2006, 2004, the price to EBITDA was abnormally high, trading at almost 22 times EBITDA. Their long-term normal price to EBITDA over this time frame has been 16.2. And you can see every time it exceeds that, the stock reverts to the mean. And then like we saw coming out of the Great Recession, when the price to EBITDA got excessively low, this was a great time to buy the stock. So on that basis, Starbucks trading at a discount to its normal price to EBITDA, or at a price to EBITDA of about 13.1 relative to their norm of 16.2. So all in all, Starbucks could actually be very attractive here on a valuation basis, and the company still does have the opportunity to generate double-digit returns. However, it's also important to recognize that now that the company is a $67, almost $68 billion company, it's going to be harder for them to grow going forward than it has been historically. In closing, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is an ongoing video, what I call subscriber request video, where subscribers to our YouTube channel have asked me to cover certain stocks. So today I've covered Starbucks. I'll be covering others. If any subscriber does have a request for a company, please let us know. We can't promise we can always cover every stock you ask for, but we'll do our best. In the meantime, if you're interested in learning more about FastGraphs, you can call us at 813-960-9600, or you can log on to fastgraphs.com, where you can sign up for a 14-day free trial and test drive the tool for yourself. But Chuck Carnevale saying thanks for watching.